Town and Lacy Hunt were right. Something bad might happen soon. What stage has Wall Street set up? Why 2023 gain is set up to be wiped out in a matter of weeks. Central banks bailed them out of March 2020 lockdown, so they went all in at the end of the cycle. However, next week is the anniversary of the lockdown crash 3 years ago and the start of the war in Ukraine 1 year ago. So it would be highly ironic if all of this widely ignored risk all exploded in the same time frame. They didn't see it last time, and clearly they are clueless again this time around. 3 years ago next week, at the start of the crash, the Weekend Barron's lead story claimed, "It's still a bull market everywhere you look. It was already too late to get out." Phil Town just said he is expecting something bad to happen this year. Lacy Hunt said financial lending condition is tightening by the minute, and money supply is shrinking by the second. What stage has Wall Street set? Why 2023 gain is set to be wiped out in a matter of weeks? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Over the last month, we have seen nearly bankrupt companies rallying 100% plus in a single day. And companies reporting awful earnings, staging a 20% plus rally the day after. Let's take a step back in time precisely to early November 2022. The leading narrative was that Powell is channeling his inner Volcker, as the momentum of core inflation kept increasing. The Fed was revising their expectations for the terminal rate higher and higher. The Fed was all about tighter financial conditions, which is jargon for fewer animal spirits. A stronger US dollar, higher borrowing costs, and lower multiples. Higher borrowing costs are lethal for very leveraged, interest rate sensitive sectors like real estate, unprofitable tech, and meme YOLO stocks. Not only that, uncertainty around the Fed terminal rate led to highly volatile bond markets. Rising bond market volatility hurts risk sentiment as the backbone of many institutional portfolios. Fixed income doesn't dampen overall portfolio volatility, but instead contributes to it. Hard to take additional risks in such an environment. But then something abruptly changed. We got a couple of deflationary prints And before the recent revisions, it even seemed that Powell's preferred measure of sticky inflation, core services ex housing, was decelerating on a trending basis. Against the backdrop of these disinflationary prints, the bond market staged a relief rally and Powell didn't fight back at all. And this is when the magic starts to happen. Mechanical buying flows from leveraged investors kick in on a very large scale. Here is how it works. Commodity trading advisors, CTAs, risk parity and volatility targeting funds often used volatility as one of their buying, selling signals. The more implied volatility drops and realized volatility keeps declining, the more these accounts can lever up and buy. These mechanical flows can be very large. I estimate these systematic strategies could be easily lifting $1 to $2 billion of US stocks per day. And the more volatility remains compressed, the longer these buying flows last. Why do these mechanical flows matter? Their model-driven valuation insensitive nature has a disproportionate effect on two types of stocks. The most shorted and hated stocks out there. The least liquid and the more flow-prone sectors in the market. Particularly, over the last 2 weeks, the extent of short covering in tech has been almost unprecedented. To further validate this thesis, the worst performers in 2022 happen to be exactly the best performers of 2023 year to date, with the YOLO guys standing out in the crowd. The US dollar is strengthening against most major currencies. Bond stock and FX implied volatility has stabilized and struggles to decline further. Systematic vol targeting accounts might have exhausted most of their buying needs. And yet the NASDAQ and the Russell are 3 to 6% up over the last month. Now to the big question. Can this continue? There are two realities to face. Markets can remain irrational longer than we can remain solvent. Long-lasting bull markets require rapidly expanding valuations and/or strong earnings growth. The dot-com bubble and the US housing market frenzy happened with Fed funds around 5 to 6%, not 0%. Animal spirits can be hard to contain, but the Fed doesn't really have a choice. After the recent revisions, core service ex-housing CPI, the sticky inflation, is still running at over 4% annualized levels. And the US labor market keeps adding jobs at an underlying realistic pace of 150 to 200K new jobs per month. The Fed will be forced to keep risk-free rates at 5% plus for 9 to 12 months at least, which means the housing market and the real economy must handle 7 to 8% borrowing rates for a long time to come. Hard to make the case for rapidly expanding valuations. On the growth front, check this. Between 2010 and 2020, we barely managed to produce an average 2% real GDP growth, with an average Fed fund rate of 0.62%. What makes you sure we will avoid a medium-term recession with Fed funds at 5% plus for long? The one who YOLO is thinking this way. Rising rates means rising recession risk, rising crash risks, and therefore rising chance of rate cuts. To get the rate cuts, you have to first get the rate hikes. The recession and the crash, meaning the bullish hypothesis is the same as the bearish hypothesis. I would remind everyone at this juncture that it wasn't emergency rate cuts in March 2020 that saved markets, and it wasn't the restart of QE. Those were both limit down events. What saved markets is when the Fed panicked and took over the Treasury bond market. Something that is so far off the radar right now. There is not the slightest inkling that it will happen, whereas back in 2020, the Fed was already in rate cutting mode and QE mode due to the repo crisis. In other words, the exorbitant Fed bailout that took place 3 years ago is the reason why inflation is running too hot today. And it's also the entire premise of the bullish hypothesis. We all agree a bailout is inevitable. But from what level? Not this one at 4,000. As Lacy Hunt said, the best measure of money is a showing of clear cyclical pattern. Decreases stretch back to Q2. And there was a sharp 7.2% rate of decline in January. And the drop in the last 12 months is a record. ODL money is the leading indicator of credit. The contraction in money supply, coupled with a rise in interest rates, has reduced the desire of banks to lend and the desire of businesses and individuals to borrow money. Last Thursday, Cleveland Fed President Loretta Mester, she saw a compelling economic case for a 50 basis point increase when policymakers met this month. And that bigger rate hikes are not out of the question. Mester's opinion matters since Mester will become a temporary voter until Goolsbee replacement is chosen. This means the Fed voters lose an Uber Dove Brainerd and get an Uber Hawk Mester in the short term. Everything the Fed is doing right now is making Treasury bonds more attractive relative to stocks. They're actively raising rates, which compresses the forward PE multiple. They're slowing GDP growth and profit growth. And yet, stocks remain record overvalued relative to bonds. Why? Because the inflation premium is still in the market. We are a binary event away from repricing that assumption out of the market. At which point it will be the end of the cycle and stocks will be bidless. This is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an amazing book. Order your copy today. And my book time. You are such a good boy for watching my video right till the end. Bye.